Hello and welcome to episode 137 of the Dash podcast. I am Mark Mason and I'm joined by my fellow co-host and amigo, Joel Valenzuela. Happy Friday, Joel.
I have returned from 1,000 years of sleep to wreak havoc.
Excellent. And welcome back to the podcast. This special episode, we have Dr. Darren Tapp, Research Assistant Professor at Arizona State University Blockchain Research Lab. Welcome back to the podcast, Darren.
Yes, thank you. Thank you.
Excellent. And I'm loving the TapMathcom at the back. Do you just want to break down what that is for people watching this via video?
Well, I have my own consulting company, and I wanted to kind of help advertise a bit. And one of the best ways to advertise is to give useful information to people. I've had the domain TapMath for a while, and so I decided, okay, I'm going to put up a blog. And so you can go to TapMathcom and look at the blog, and there's one post we're going to talk about that involve ChainLocks, and some other ones involve Linux and open source software, digital signatures, and what I was surprised that got a lot of traction. I wrote something about how to type up mathematics, and apparently there's at least a good hundreds of people out there that want to type up mathematics and want to do it in an efficient way. And I was surprised that it got some traction. So it's just something for me to talk about what I want to talk about. And also I feel like the open source community have just given me so much that really, literally, like they've given me so much, and I've read so many tutorials and so many things and learned so much. I just kind of want to give back. So you can go to TapMathcom, and then there's a blog from there.
And that specifically, well, I'm happy that you're on the podcast because you made a blog post not too long ago, which was about the security analysis of ChainLocks. And you're saying the analysis is complete. So I wanted to hear from you, like, what did you do? How did you analyze ChainLocks? What was the conclusion? What was the results? Can you just break it down for our viewers and listeners in as simple way as possible?
Well, when I worked for Dash, one of the first questions that I asked them, what math do you need? And they're like, well, we need to know how secure this is. And they were doing quorums with 10 masternodes. And so I told them how to compute it and how to compute everything and know how secure it was. And I came up with the answer, no, it's not secure with 10 masternodes to do a quorum. And it depends on what you're trying to do. You know, if it's going to bring down the whole network, you don't want to have any chance of anything going wrong. Or if it's just like one little hiccup, then it's a little different, right? But I gave them a spreadsheet, made a spreadsheet that would do the calculations and all that, and then they came up with their documentation. I wasn't working for Dash and wasn't really keeping up with it, but they came up with their documentation, which you can read on GitHub. That's DIP 8, and they wrote up what they did, and you have to reference the other dips, but when they do a chain lock, that uses a quorum of 400 masternodes. And so I tried to pull up the spreadsheet I used, and it was just impossible to even get that spreadsheet to do some of the calculations that I needed to do. So I've learned that anytime I can't do a calculation with a computer, go to Python, this programming language. And Python is just amazing. Like you say, compute this really huge number. It's got 100 digits. It'll give you all 100 digits if it's an integer and things like that. And that's what I needed to compute was integers and then take their quotient. So Python totally would do these calculations. So I wrote up a little Python script to do these calculations. And I did this just for myself because I wanted to make sure that as somebody who owns Dash that I'm not just basically crazy. I want to actually know everything works. And so, yes, I came up with numbers that convinced me that, yes, this is a great way of doing things, and it gives you a lot of security. And, I just ran a few samples, and but then I got a question from the Dash core team, like, oh, I'm doing some calculations. How do you do them? I'm like, oh, I have a script. Here's this script, blah, 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 right? So I immediately put it on GitHub, or I go through it and clean it up a little bit, put it on GitHub, and try to explain how to use it and all that. But then I've already done half the work of all these calculations. It kind of bugged me that you read this DIP 8 and there's really nothing in there about why it's secure. It's just about how it works. And so and then if you read Satoshi's paper, there's a section that's called calculations that's where he shows that this can't be attacked unless it's a 51% attack. That's where the 51% attack came from. It's from that section, calculations. And so, well, with ChainLocks, the calculations aren't as straightforward. They weren't really straightforward in the Satoshi paper, but you could do the estimations easier. But anyway, so I just put a section in DIP 8 called calculations. And then there's another section, which is security considerations. So I put two more sections in DIP 8, and this is open source project, so I just did a pull request. It's approved. So now it's officially part of DIP 8. I got to go through the numbers again. I want to check it again, but because I might have got it a little bit off somewhere. But there's a table there. That table is very firm and secure. I mean, I did those and checked those numbers a lot, and this whole table is assuming that 30% of the masternodes are owned by somebody that wants to destroy the network. Okay, and I was finding in that case that they would have a very small chance of ever producing a malicious chain lock, making a chain lock that wasn't within the rules as a software is. A very small chance of making a chain lock in the next sextillion years. And I had to actually go out sextillion years to even get a number to report. So it was like,
I think that was my favorite quote in the blog post. I mean, because let me read it. So my as you say, my favorite quote is: the attacker would have a less than 1 in 100 trillion chance of producing at least one malicious chain lock in the next sextillion years. I didn't even know that word existed.
Right.
But as you point out, though, this is assuming that 30% or less of the masternodes are controlled by an attacker. But like, so
one attacker.
You wanted to check that claim. You wanted to make sure the math was tight and solid. So
yeah.
Is it good? Is it watertight? Is it all hype? Is it all fart or no poo? Is it good or bad?
So it was up to 30, and then I posted that post on Reddit, and they was like, where? And then somebody asked, where is the cutoff? And I'm like, oh, let me try to find the cutoff. And I was getting they asked specifically if there's 5,000 masternodes, because it actually depends on how many masternodes there are. So I tried to do it. I just did the calculation, and I'm like, where do you call the cutoff? And I was like, well, in statistics, if something has less than a 5% chance of happening, it's called unusual. And so I think I'm going to edit what I wrote. I'm going to do another pull request at some point and actually compute where these cutoffs are, where it's unusual. So I think that we should make the bar that we're going to, that there's less than a 5% chance that there's at least one malicious chain lock in the next decade. I think that's what we should consider be failure, right? Less than a 5% chance, or if there's more than 5% chance, then that's too much. Okay, in the next decade, that's statistics. That would be unusual. So you have 10 years of use, and it would be unusual if there's a chain lock ever. So I'm just saying, if you set the bar there, and that's not in DIP 8, but that's a question you could ask. That set the bar there. Where's the limit? Okay, it's kind of an arbitrary bar, but I think it's.
Does it come down to the testing environment though? Because in a real world environment, of course you can run the numbers, but like, does that alter things? I mean, like, how watertight?
Yeah. So. Okay, so if you want a malicious chain lock, you need to actually control the masternode to make a partial signature. And I mean, part of the question you're asking me kind of came up, when you do these pull requests, there's a discussion. And so the Fez, who was contributing to the discussion, was saying, well, what if a few of the masternodes went down? And so I put a few extra sentences in what was written up that the attacker could be combining it with a DOS, all that. Basically, if you read the section, it says there's two things that can go wrong. The attacker could prevent a chain lock from happening, and it can make a chain lock that's not within the rules. And that's not what you certainly don't want. That you want the chain locks in the rules. And because basically, if somebody was making a chain lock not in the rules, they could do something like lock their buddies' blocks, but not their neighbors, or they could lock their own blocks, or basically get more money than they should. It's kind of like akin to a selfish mining attack. It could be kind of severe if somebody did a malicious lock, because if like somebody had 60% of the masternodes, they could prevent all the chain locks from coming out, and then 5 blocks back they make their own block and they could lock that one, and that would be bad. But the reason I brought this up is that the attacker would need to control such an insane amount of masternodes for that to happen. That's so yes, there's things that can go wrong, but okay. So if you've been watching what's been happening with Dash, you might go back and see some interviews with Evan. And part of what Evan is saying, Evan Duffield, right? So part of what he says is, well, there's an economic incentive that masternodes aren't going to misbehave. Okay. And so when I was writing this up, I said, well, even if an actor or a group of actors, a consortium of actors, decide that they don't care about the economic incentives, they still can't do it. And that's part of what Satoshi's paper was about, was even if the malicious actor wants to double spend without 50% of the hashing power, they can't do it. Does that make sense? So it's just so in what's written up, 30% is a very hard bar. Like you're not going to get an attacker preventing chain locks, and you're not going to get an attacker with malicious chain locks if they have less than 30% of the network.
I think that presents a really important question you just touched on, because of course a lot of people have been talking about block reward reallocation and what that sweet spot is, whether it's a good thing or a bad thing. Of course, people talk about it from Ryan's presentation about improving Dash as a store of value, and a lot of the focus is on improving the economic incentives, but there's also a security aspect as well. And just to keep it simple for the audience, is there a danger? Is there a risk here? If we reduce the reward for mining, does that present a security risk, or just ChainLocks mitigate that risk?
Yeah, I was asking some questions at the open house because I had been thinking about this, and when you ask questions, you get to the part you need, and you don't. Anyway, so I was worried if you reduce the proof of work, then the proof of work is actually what SPV wallets rely on, and so I was really concerned about that. I mean, I'm just like, that's the first thing that kind of popped in. Like, everything seems secure. Well, what about SPV wallets? Which their main security model is that they have all this proof of work. Okay. And so I was asking around, I asked around on Reddit before the open house. I asked during the open house, and the answer I got at the open house was that they did check for when the masternodes were registered on chain. And so if you can get those public keys from the chain, okay, so an SPV wallet, when you register it on chain, that's just a transaction, and an SPV wallet can verify that was a transaction that was in this block with a Merkle proof. That's what it normally does. So if an SPV wallet could know that these masternodes registrations most of them are buried. Like right now, they're almost a year old, a lot of them, and some are newer, but a slew of masternodes have been online for quite some time, and even a month. If you have something buried in a month of work, that's a lot of work. So when this transition happens, it's just important to think through what the security model of SPV wallets are with reduced work. Okay, because with a Bitcoin wallet, you have this insane work. There's no way anybody really can spoof that. With Dash, the X11, it would be hard. It would not really be worth the trouble to try to spoof an SPV wallet with Dash. But if you reduce the proof of work, then all of a sudden it becomes more reasonable to try to spoof an SPV wallet. But if you had an SPV wallet that was checking the chain locks, and it was those chain locks it was checking relied on the public keys that were buried at least a month into the chain, even if you reduce the proof of work by 100%, or down to 1% of what it is now, once you go past 100 blocks in the past, you have the same amount of work that one block would have had before. And if it's a month in the past, with Dash, it's over 400, 500, whatever. 144 times 4 blocks are in every day, and then times 30. So that's some kind of number, and that kind of gives you an idea of, even if you reduce the proof of work this way, if your SPV wallets were checking the chain lock, they would still have an extreme amount of security, right? And when I was talking on Reddit, some guys from Hash Engineering started answering my questions, and I haven't had time to go through all the details, but I'm convinced that they have been thinking about it. And so I think the security of SPV wallets at post ChainLocks can be there. SPV wallets actually can use ChainLocks to get more security with less proof of work, right? Mm-hmm. So your question about reducing proof of work, well, that's one hurdle kind of gone, okay? You have to change your SPV implementation. I mean, SPV implementations is associated paper. Everybody understands that. You have to have a new implementation of SPV. And so we have to, I don't understand that yet. We need to understand it, and then
here's the thing,
can
Darren.
Be more secure. What's that?
I appreciate you doing pull requests and your mathematical whiz kid and putting these numbers, but I think in terms of external perception, is ASU doing any research on this? Because I think having an external entity really review this and give their insights and thoughts will actually go a long way, rather than just us saying it works.
Right. Well, so your question is ASU, and there's a fellow by the name of Jonathan, who's this undergrad student at ASU, and he wants to do an honors thesis, and his honors thesis is come up with an economic model for how Dash works. That's basically what we're asking to do. And so, ASU is, I think it's still on its break right now, but I've been meeting Jonathan remotely, and we've been talking about the things. We got an economic professor on board and another mathematician up there. Dragon is there. We have a lot of people that are kind of overseeing, mentoring Jonathan, and my hope is that he comes up. Well, I mean, by March or something, he'll need his thesis, kind of at least maybe a draft of his thesis. So, my hope is he'll have a model that comes out of this, and then once we have a model, then we can start to optimize it. Right, we can kind of say.
How would you go about doing that as a thesis? So, basically, you would test different block reward allocation percentages, right? And then run the numbers and then see which one. Yeah, and it depends. There's a lot of things that you want. When I say optimize it, you can optimize it for different things. The main thing I personally have been pushing for is what we're calling price stabilization. Okay, so, and that's kind of what Ryan was getting on that as his store of value, and I've got a little bit of bad blood with the word store of value. So
don't we all, huh?
I go to Ryan, I say, how about we say reduce price volatility, right? Because that's kind of, if store of value would have the same value today and tomorrow, right? And he's like, well, that's not really what I want. And he's like, I want to reduce price. He wants to encourage price stability. He wants the price to be stable. Right, so these huge peaks and these huge lows, which you see throughout the crypto space, and I was convinced in Ryan's talk that that's kind of the way the economic incentives are set up, as Ryan presented that, and Dash is more severely hurt by those than others. Right, that's kind of what Ryan said, and Ryan convinced me of that, and so we're trying to say, well, what if we do it a different way? Could we now could we do this? So clear from the price stability standpoint, clearly the more we reduce mining, assuming Ryan was correct, that should lead to more stable price because, he was saying the miners dump it and things like that. When the price gets low, they have to spend it all. They have to sell it all just to recover the electricity costs. So if you could reduce the mining reward, that could do. And what I've been talking to Jonathan about is like, what if you could make the staking reward kind of adjust based on how many masternodes there are? So basically, when you think of these masternodes, there's this transaction on chain, and it sits there. It's 1,000 Dash just sits there, and we can say that 1,000 is sequestered. It has to stay there until if the masternode wants to get paid, it has to stay there. So we could talk about this money that's sequestered. It's not circulating, and so we could. And now that we have masternodes registered on chain, we have a Nakamoto consensus about how much is sequestered, right? Well, I mean, it just is out there. It exists. We know it, and so you can make the protocol adjust the staking reward based on the number of masternodes. So if the number of masternodes the way I'm thinking right now is if the number of masternodes goes down, then you could have the staking reward start to go up. And then so like as there's less sequestered over here, in theory, more will be sequestered over there. And what I asked Jonathan to do is go to the economics professor and understand how with normal government currencies or traditional currencies, whatever, how does the interest rate affect the exchange rate or the value of that currency? And with a staking reward, if it's changing, you can kind of think of that as an interest rate. So that's kind of that's our avenue of attack right now. But ask me in 2 or 3 months, we might have something better, or this is still in kind of speculation phase. Luckily, we've been able to pull some data from Fred. Yeah, from Fred, which is from St. Louis. They give them interest rates there, and so we think we can actually check some hypotheses against data, anyway, this is economics. They say that economics is a dismal science or something like that. So,
I like economics.
Yeah,
it makes sense with everything.
So the thing, yeah.
Sorry, go ahead.
Oh, the thing in statistics, there's things called a confounding factor, and I see them all over the place. So you can have kind of whatever theory, but if your theory is based on some other factor that you didn't consider, there's a problem. Your theory is not going to be that great, or not going to come to. So, like a confounding factor, for example, is number of deaths by drowning is correlated to ice cream sales. Okay, there's a correlation, and it's there. It's real. There's more drownings when there's more ice cream sales, and it's a positive correlation. There's less drownings with less ice cream sales. Well, with this, there's an outside factor that is the weather. When the weather gets hot, there's more drownings, and there's also when the weather gets hot, there's more ice cream sales. So, of course, they're correlated, but there's not like a causal thing. So, we need to go through this interest rate data, and we need to somehow strip away all the other factors, which for a global economy, that's almost an impossible task, right? But
you asked an interesting question on Ryan's presentation at the end, based on economics. You're quite enthusiastic and excited,
right?
And you were saying that it was quite interesting because you focused on the circulation, but you're saying that the proposed measures were quite good because that Dash then would be reused, as opposed to, I forget the term that you used, but it was a monetary term.
So I was interested in this question too, and I'm almost embarrassed to say I think Ryan got further along than I did, because my approach was actually just look at the traditional markets with the money. There's books on monetary policy, and so I just my little secret is I look at syllabi for classes. They are just online. You can look at it. I'll see what the textbook is, and I'll buy that book. cheap college for anybody who wants it. Anyway, so I'll buy that book, because that's what they're teaching. That's fun. And then so I looked at what the monetary theory was in this college, grad level text, and there was 3 monetary theories, and they all say that as money is moved around more and more and more, that's called the monetary velocity, that the value of the money decreases. It kind of acts as inflation. If you have a dollar that goes from here to there, then it's actually acting like it's $3 than if I had a dollar and just sits there, right? So so the velocity actually puts downward pressure on the price. And while I worked for Dash, they had me look at something Craig Wright wrote, and there was this equation, and it had a direct correlation. But in the text that Craig was writing, he was assuming there's an inverse correlation, and so the whole thing was, the words are saying one thing, the equations are saying another. It was just weird, but I was like, that's a real equation that Craig Wright was using. So I was like, okay, where's that equation? So got the book with the equation, and so yes, as monetary velocity goes up, which is what Brian has been encouraging. We want Dash to be a medium of exchange. We want Dash to have utility, and I agree with Brian. We want utility. We want Dash to have utility by using it as a medium of exchange. That just the theory is that puts downward pressure on the price. The saving grace is what's called aggregate demand. So if you somehow had like 10% of all businesses switch over to accepting Dash, then all of a sudden there's this. That kind of all adds up to demand for Dash. And so it's the total amount of demand for Dash in aggregate. That's what you want to increase. And as that increases, then so does the money. So if you study this in terms of traditional monetary theory,
you're essentially becoming a central bank, right? Because that's what you're doing. You're managing expectations all the time, doing that, and then putting levers and mechanisms to try and balance things out, right? Okay, inject some money here. Okay, put it back a little bit. Stabilize the economy.
Let me add a correction. More like a decentral bank, because it's not one person, one entity running it.
It would be pro-school level, right?
We worked it out ahead of time, and we like, when this happens, we'll make it go like this. The first thing I asked Ryan and Bob, because we met after the open house, we met privately. So I asked Ryan and Bob, I was like, do you have the price on chain? Okay. When I worked for Dash, they were like, can we put the price on chain? And I went through it. I'm like, no, not securely. And they asked me again, no, not securely. No, not securely. Right. So I actually asked them if they could do what I couldn't figure out how to do. And they said, no, we're not going to be able to have the price on chain.
What do you mean price on chain? Do you mean put in from exchange rates?
If you just put it in the chain and, get that proof of work on there, then there'll be Nakamoto consensus on it. But the thing is, like, you can't ever be certain that whoever's putting it in the chain didn't lie about it.
Mm.
And you can't ever have the incentives or at least we could never get the incentives lined up where it wasn't in somebody's interest to lie about it. So so basically, that was my first question. Can we get the price on chain? Because that way everybody can agree on it, and like we get a Nakamoto consensus, and we can use that in the protocol. And so the answer is no. But if you could use it in the protocol, then you would just do what the Fed does. If the price is too low, you raise interest. If the price is too high, if it's too high, you lower interest, stuff like that. And when I say price, it's the price of money, which usually turns people's heads through a loop, right? Because the price of money gets high, then the prices of your goods get less because less money is worth more. Anyway, so my words might be a little backwards on this, but the way I think of it might be backwards, but
what about the inflation issue though? Is because has that been a problem for you before? Because like when you look at Dash's inflation compared to other cryptocurrencies, it is pretty high, and it does need to, and Ryan was right to point that out, right? So you must have thoughts on that. Yeah.
And if you look at others, it is pretty high, and it's so funny that the one criticism is the instant mine, right? Like the instant mine, it was all mined early, and like if it was all mined early, how is there so much inflation today? I mean, like when I started, like it was less than half were issued. I'm like, well, there's still plenty to come out. What's going on? These people don't make much sense here. I mean, it's not ideal, but we can only go forward today. So some people that say the inflation's too high and that's a problem are all the ones that say, an instant mine, that was a problem too. The fact that it was over back then. So just think about that. what my approach is if we can keep I call it monetary inflation. There's two different, like the monetary inflation the amount that the monetary supply increases. And there's also the Keynesian idea of price inflation. I have to use two different terms because they're two different things. So with the monetary inflation of Dash, I think that if you can somehow set the inflation schedule, like let's say there's a change in the inflation schedule, and you can change that inflation schedule so that it's less than what it would have been before, I think that you can avoid a lot of criticism. Does that make sense? I think that if we said, okay, we're going to inflate it, but it's going to, right now there's a hard cap somewhere around 19 million, maybe 18 million, somewhere around there. They say, oh, we're going to make it 50 million. People are going to, I think people in the community, and I think rightfully so, would say, well, that's not what I signed up. That's not what, as a Dash user, that's not what I signed up for. But they said, but if ASU recommends, hey, here's this, what we recommend, and we think in the next 100 years there'll be 16 million Dash issued, which is less than what would have been issued. I think that the community will accept that. I think that's a reasonable thing. So and dilution is one of Ryan calls it dilution. That's a good term because that's what it is in VC land. And dilution is one of the things that we want to optimize over. And Ryan goes so far as to even worry about, when it's diluted, like you get the masternode rewards, you're diluting yourself. But Ryan's saying, well, what about the IRS? They consider the reward to be income, right? So you'd be better off not diluting yourself. And that's also something we're trying to consider, that we're trying to consider dilution, and we're trying to consider dilution assuming that the masternode pays taxes on the revenue. So we're just trying to think through all the possibilities. And dilution is something we do want to optimize over. We don't want to just start, come up with something that puts 50 million Dash in the future. And like I said, I think that's a pretty good bar, that, there's not more Dash issued than would have been issued today. Or does that make sense? I think that's a bar. Oh, yeah. I think that's a bar. That's where it should be. I mean, right? I mean, if we're going to do major changes, it could change monetary inflation. I think as long as it doesn't go over.
There's a credibility issue, though, and reputation, because when you're talking about distribution, if you change things up, like most people know off by heart that the total max supply of Dash 18.9 million. Now, of course, we know it won't be that because not all the coins are created, right, the treasury and everything else.
Right.
But if we start switching things up, then that changes the total max supply of coins that will be ever created. And then we can't keep changing that. Otherwise, it's kind of like central banks. Once again, they give forward guidance, right, on what they're going to do. So this is really important. And I really think an important thing to establish and clear up is, once again, to do with the miners. So if the miners are doing the blocks and we reduce the proof of work and we're much more dependent on ChainLocks, is that going to present an issue with scaling Dash? Because you've been involved with ASU. In fact, the research paper for scaling Dash. Mm-hmm. Do these changes affect scaling? Now that research paper that was put out on how to scale Dash with ASU, was it up to like PayPal levels? Is that still standing, or do you have to go back to the drawing board now?
Not back to the drawing board, but we have to rethink through some things. Yeah, so the ones for PayPal level. So you're talking about the first paper. That stands. That stands exactly the same. That's still true with ChainLocks. ChainLocks uses a little bit of bandwidth. It's not that much, so that doesn't have much effect. And ChainLocks happen after the block propagation. So ChainLocks doesn't really change anything on terms of that. Now the thing that ChainLocks does change is if you did have an orphan rate, it becomes more serious with ChainLocks. Okay, So in that first paper, we're going to like half PayPal or something like that levels. We're to 10 megabyte blocks. We did not have much orphan rate at all for compact up to like 4 megabytes. So the ChainLocks isn't going to really come in to mess anything up or to be an extra hurdle. It's not going to be there up to 4 megabytes. And then with let's see, with the Xthin, I think we're still getting like 0.5%. Xthin up to 10 megabytes, which is when you're getting up to PayPal. I think we were getting about 0.5% orphan rate. I don't think that's going to be too much of an issue. I mean, the thing is that the ChainLocks will exaggerate an orphan rate. Once you start getting an orphan rate, ChainLocks will just exaggerate that orphan. Like basically, you got 2 blocks at the top, and it's going to take them a while to figure out which one to lock, and then actually, it's going to help. It's going to help once it's locked, then everybody gets along the same one. So it's going to help some. But I mean, with Velocity, we wouldn't have gone to. This was Visa level. Velocity went to Visa level, so we wouldn't have ever put that live because it had a 33% orphan rate. And once we get to a 33% orphan rate, I don't want to see that and ChainLocks together. That's what so you just make sure you have a small orphan rate. That's it.
So what's the state of play with the ASU research then? What's on the agenda to-do list? So you've got the economic incentive research that's being done. What about scaling? Is that back on the list? And also security as well.
So from my understanding is scaling is not on the list right now because they don't need it. And they're kind of true. And and the way I'm a Dash user looking at the network, and I know they have 4 megabytes in their back pocket. Like they, it wouldn't be that hard. That would be actually easier than when we went from 1 to 2 because we didn't have compact blocks back then, and they put compact blocks in later. So 2 to 4, they got that in their back pocket. They can do that when they need to, without any extra research. So basically, when they start putting 4 live, and right now, I mean, the network hardly is ever at 20% capacity. So I would like the line to be at 20% capacity, but I want it to be 20% organic use, not once we set the bar there, people push up the transactions to go over it. That doesn't make any sense. Just let the organic transactions happen. Once it starts running around 20%, generally, I think we need to talk about bigger blocks. And I mean, like I was wanting to go up, and they went from 1 to 2, and then I got some pushback, and I'm like, well, where's the bar? And so that's the bar I'm drawing, 20% capacity. When it's a 20% capacity, I'll start talking again about it. So we're nowhere near there.
Okay, Joel, do you have any questions? I've kind of been hogging Darren a little bit.
Recently there was a 1.6 megabyte block. No problem. No problem. Just like the research said.
There's some little territory on the economic incentives of everything because that's one thing is I find people in life in general, but also like in crypto systems and things like that, tend to get angry at stuff that happens and just say shouldn't be that way. Stuff is not working. It shouldn't be that way. And as I was mentioning when we were just talking earlier, I was talking about how it's just that the economic model's not right. And so you rather than just get mad at stuff for not doing what you want it to, switch the models so it all works around. Yeah. And so, for example, there's a lot of there's not very good voter turnout in the Dash masternode network typically. Right. And so, I mean, what I would call it's not a high percentage. So obviously you don't need to vote to run a masternode. It's a privilege you get, but you don't need to vote.
Right.
And so some people don't vote because they don't want to be they don't really care about being involved with that. They just want those recurring rewards on the 1,000 Dash. So you were talking about the sort of seesaw mechanism between like a potential thing between stakers and masternodes, which sounds very similar to something that Pivex figured out. And I'm sure that's a whole different conversation, but if you can either stake, so here's the thing. Staking is obviously the much easier way of getting a return, getting some of that inflation back into your value, right? So it's not like the central banks where they inflate money and they keep all the extra stuff.
Right.
If you have like a 50% inflation rate per year, but it all goes back to you, you don't really care. You just
and then that's kind of silly. That's weird accounting. Let's not do that.
Yeah, but it is kind of silly anyway. But so imagine a situation where you have masternodes and stakers, but you also have a mechanism to create trustless masternode shares, which at this point might seem like irrelevant because people can already stake. But at that point, first off, you have like an equilibrium between. At that point, both mechanisms allow you to put up your Dash and get recurring income off of that. And at that point, the actual premium comes on, well, if you want to actually go through the extra work to run a masternode, then you're paid for just that. I mean, even though that's like the barrier to entry is the Dash that you 1,000 Dash or however many for a share you put together in this hypothetical. So right now, people are getting interest, let's say, on that. And a little bit of the money they're getting paid is probably incentivizing the actual work of running a node. But under the situation where you could just stake it, if you're doing a masternode, you're probably being paid just to run a node, and you might be a much more active network participant. Or you might actually be taking a loss because there might be more, you might be able to make more money by just staking, say, your 1,000 Dash. You might be able to make a little bit more in that bit, but you're willing to take a small cut on your profits because you value, as a community member, you value being able to run the network and having input in the vote and stuff. Okay. So that might really jack up participation rates, not by saying, well, you got to participate, you have to vote at least in order to keep your vote, like all this, like, pardon my language, but statist kind of thinking that people sometimes have about compelling people to vote. Why not just make it so the economic incentives are aligned so that voters actually get to vote? Like people who want to vote get to vote. And
so I think there's something interesting into that, what you're saying, Joel. What I wanted to do to try to encourage more voting, and it was two parts. The first part's done. Okay, so when the masternodes go on the chain, there's an extra address that's picked, like normal Dash address that the masternode runner has to pick, and that's the voting address. Okay. Yeah. So now that you can use an address and just put it on chain, that's the voting address. I feel comfortable. I imagine a masternode owner would feel comfortable just voting from their phone, because that key there is only compromising the vote. It's not compromising their collateral or their rewards or anything. It's just only the vote. Because if they use a different key for only one address for voting, that's only key they never use for money or anything. Then that's the second piece. Is the first piece is put that voting address on the chain, and the second piece is give me an app that allows me to vote from my app. So I don't have to like a masternode owner wouldn't have to go on this Coin Central, read everything, and then go to the terminal and type some kind of weird thing. And I think that would encourage more voting turnout. The thing you don't want to do is actually pay masternodes more if they vote, because then you'll get people voting whatever way just to get more money.
Yeah, of course.
So you don't want to do that. But
I do agree on that, by the way, because I've actually, generally speaking, like when people always talk about, when people talk about societal ills, like, there's not enough this, there's not enough that, not enough, pick whatever, we must mandate that the government tax you more and pay for this service or whatever. My first thought is always, let's look at the barriers, the artificial barriers to that happening to begin with, and then remove those. And same thing with the voting thing, rather than, let's change it all up. Part of it is just too different. Or people, and I've had this actually in experience before, where people are saying, sorry, I love what you do, but I can't vote for you this month because I'm on vacation wherever and I don't have my hardware law. And it's like, but they're still talking to me on a device. Yeah. So that device could have the voting key if they don't have to compromise the security of the other stuff.
In the early days, you don't want your collateral key on your phone, and that's what you voted with, I think, or that's what the way it was set up, it wasn't easy to have a voting key. But now you can use voting key can be anything. So if you picked a key from your phone, you could vote from your phone. It's just I don't think the software is there yet. So
yeah, it would be great to be able to great to have your voting key like on your platform username, your like main spending money one, not your whatever it is for your hardware wallet. You're safe, and so you just your little like basic little pocket money one, because who's going to steal your one? I mean, unless you're a whale, if you're like an 88 vote whale. You know who you are. If you're one of those and someone like steals your phone, they can like swing the whole. But if it's like one vote, like no one's gonna steal your phone and try.
You can change it after they voted, and then you just there's an update transaction you put on chain to change your voting key. And so, like, if your key ever gets compromised, just put that update on chain, and you're back in the game. I guess the worst case is they steal the key and they put their own update, but. There's been, behind closed doors, they were talking about ways of dealing with that. But, worst comes to worst, you would change your collateral. Just move your collateral somewhere, and you get a new voting key. I mean, the thing is, if you move your collateral, you might lose a few days in the queue or a few hours if you time it just right. But I think it's worth it to actually own your vote. It's worth you're losing a few days of Masternode running. But I don't know. Maybe other people agree. I don't know.
Yeah, that's exactly a thing that people get into.
You can't update with the voting key. You have to update with something else. You can't update with voting key. So never mind. Just change it. Just update it. Yeah. The security of it's there. It's just not this user. It's like Evo right now. It's there. It's just not a user. There's no user interface right now. In early days, Bitcoin, it was the same way. There was hardly an interface. That the QT thing, which is what we're still using, was kind of horrible. And the power users early on were all doing things through the command line anyway. So,
what are your thoughts on user staking? Because that was a big part of Brian's presentation of what could be. We could create a new allocation to user staking. And as you mentioned, Evan Duffield back at the beginning, when he first started speaking about evolution, he had a mock-up of a Dash QT wallet with a savings account, and he used the expression, you could put some Dash there, like digital cash, and it'll spin up a masternode in the background. User staking is interesting, but from the technical side, does that appeal to you?
So there was this shared masternode idea that Evan came up with, and I think I even put it in the paper that I asked Dash for a job with. I was worried about some of the game theoretic situations that run up with the shared masternodes. And it's all over voting. Okay, like who gets to vote? You can't let the person running the node gets to vote, because then they can have undue influence. They just become really good at running nodes, and everybody wants them to run their node, or then they get a lot of vote for not having much skin in the game. So you really don't want that. And then you could have the people doing the staking, they all vote, and if the majority of that node actually votes a certain way, then or 10% of the voters or whatever type of bar you put, then you could have the whole node goes based on how the stakers do. That works out game theoretically a little bit better, but that's much more difficult to enact. And so when the staking idea came up, I've never really been a big fan of the staking idea, but when it came up, it's like, well, that solves the game theory right there, because there's no vote. It's the same thing. It's nobody runs a masternode, and it's shared masternodes without the masternode and without the vote. And the fact that it doesn't have the vote means you avoid a ton of game theory complications. So I was like, yeah, fine, no game theory complications. I'll take it.
Well, that's why I like the idea of trying to find some way to still do trustless shares, even if you have staking, because you don't have those problems where people are just trying to get in and just trying to get some money back, and then it complicates the voting situation. But also, for example, if everyone goes and runs, does their own staking, like now, can you imagine pooled masternode services? No one's going to use those anymore, because you don't need to pool to have a masternode because you can just stake. But then you have a smaller percentage of the collateral making all the decisions for the network, even when there might be demand for other people to do that. So that creates an interesting kind of a situation. So I think it would be interesting if people could, first off, still do a trustless share setup. So if they really want to have part of the vote, they can. And then also, CrowdNode has a great service right now that lets you delegate your voting key to their customers. So it's kind of like however the votes go, like you add your vote to the potential pool of that kind of thing. So for the people who want to run a whole masternode but don't necessarily want to deal with the voting themselves, they can kind of do it. Right. A free market for voting, I think, is a great idea. And
the delegation with the protocol change in 13 and 14, when the masternodes went online, that delegation, that's already anybody can offer that service right now without. I mean, there's nothing else needs to be done to the network. You can offer that service now. You just have to get masternodes to accept your address as, yes, you'll vote this address for me. That's fine. I mean, go ahead and set that up. But the thing is, like, you have to convince the masternode owners you're going to vote the way they would, or the way they would if they had the time to research everything. So I think that, we wouldn't want to have a central point here. We'd want to have a few voting. It's kind of like you had political parties, right? You want to have more than two, hopefully.
Yeah.
So will you be posting more Dash research or posts on TapMath.com?
Yes. One reason I really started this is I wanted to encourage people to test the signatures on when they download the Dash client. I want them to verify their signature, which is you can do. It's just cryptography and computers, and especially the masternode owners. And I put that in dip 8 actually at the bottom. Security considerations. It's more important that the masternode owners are actually running the right software, because the malicious actor can control the node just if they can run the software. They don't have to actually have the collateral. So I just want people checking their signatures. That's it. It's like health organizations say, wear condoms, and I'm saying, well, check your signatures. Don't get viruses.
Which, by the way, that would be an interesting idea to actually have condom wrappers that say, check your signatures on it. That might be a little too in depth.
So I wanted to do a propaganda campaign. So I'm going to need a blog to do that. And then I actually started to write up the posts about I made a video. So you can watch a video about how to check the signature. So I started to write up the post, because not everybody's going to want to watch it. It's like a 10-minute video or something. Not everybody's going to watch the video. So I'll just write up how to do it. And then that has grown into 2 posts, and I don't know. So it's taken a little bit longer than I thought, and I put up some other information in the meantime. But once I get that done, I think I want people to have fun. Especially if you're a masternode owner and you have your own server, you can put Alexander Block's key on your server. You can run the command right there. You don't have to do it on your own computer. And you can see that it says good signature, and then another thing at TapMath is I want to explain how you sign other people's keys. Like once you have some type of belief that that's the right key, you can sign it, and that just makes the whole signature infrastructure a lot stronger. So I signed Alexander Block's keys. Technically, I broke the rules because I'm supposed to verify that's the right key in person, but it was the one on GitHub. It was the correct signature. There doesn't seem to be anything wrong now, so I sign it now, and so I can verify that there's nothing changed in the future about it. That's another thing you're going to see at TapMath. So there's probably going to be a lot of me talking about digital signatures there. And then I was talking about LaTeX, which is how people type up mathematics, and that got a really good response. So I'm probably going to do a little bit more about writing about how to type up math and things, because people apparently they want to type math, and at least there's a contingency of people that want to type math, and it's really easy if you know LaTeX, and you make professional documents that way. So
that's what
a little bit more about that.
That's what I was going to suggest. I mean, I love the blog posts, but if you could break down in simple terms how you're using Python and why you're using that code and what it's actually doing in simple terms, I think it'll really help engage the community a lot more in what you're doing.
Okay.
Because people always want the bottom line and the quote, but if they can follow through and understand why you're doing that code and why you're running those numbers, and you're already registered as an author on Dash News.
That's a good one. Yeah, that's already 2 or 3 articles right there. I can write one blog post about how I use. There's 2 ways I use logarithms to help Python compute what I need, because if you just ask it to do it, it doesn't. Python doesn't do it, but it has a whole slew of logarithmic functions, and you can use those to actually compute what I need. So that's 2 or 3 posts right there. So thank you, Mark. This is really fertile ground. It's like once I start typing, it's like it's going to be something else. It's going to be something else. The thing about my brain is not I feel like proofreading drives me crazy. So if you find a little typo, you can email me, Darren at TapMathcom, and I'm just trying to make this a good resource for people.
No, it's great, and I encourage people to follow your Twitter account as well, because you're always posting most things, sometimes security stuff as well. But interesting. So it's at computing FTW, crypto for computing.
Yep.
Computing FTW.
Computing for the win. Yeah.
Computing for the win.
And then I'm on there as Darren Tapp as well. So I put my name Darren Tapp there. Computing for the win. So FTW. So
excellent. Well, I look very much forward to the upcoming ASU thesis on improving Dash as an economic incentive structure. And I really like your idea about the automating, the balancing for the stability. If that is possible, I really like the sound of that, because
it's just that if you get off only a little bit, it could go wrong. So you got to get it right. And you really can't do it to testnet, because it's the economic incentives that are here. So but anyway, that's kind of where we're at now. And like I said, ask me in 2 months, I might give you a different answer.
Fantastic. Well, Darren, thank you so much for joining us on the podcast.
All right,
and I hope our viewers and listeners have found it to be informative. Joel, would you like to take us out?
Yes. If you like what you saw here, like, comment, share, subscribe. We're trying to get as many likes as we can, boost the algorithm, et cetera, et cetera. We do put out a recap post. So look out for that for the audio-only version of this.
All right.
Now, it's probably that time, isn't it? What do you think, Mark? Is it?
Yes.
Yes. So there's this thing called the after party, which we have had without fail. And basically it's like this, except it's not recorded, so don't worry about the stuff you might say. And it's not just the 2 of us and an illustrious guest with luscious long hair. It's as many people pretty much as want to come in and get crammed in there as possible and just chat and have a good time, get a beverage, whatever you want, and just hang out. Called the after party. Woo, because this is like the party, but then we have the after party. It comes after the party, which is now over. So to get into the after party, go to the Dash Talk Discord. StayDashy.com. It's right there in the live chat right now. StayDashy.com. You get in, and then you just start asking around. It's like a speakeasy or something. You're just like, hey, where is it? Where's it at? And they show you behind the curtain, and then you go in. You say the password, and there you go. And then you're in. And you just hang out with us. And
unfortunately, I'm going to be on a different call, so I wish I could join you guys.
We're spoiled enough by your presence already.
Yeah, but I love talking about this stuff. And good. I'm glad that you're making this podcast for people, and thank you.
Oh, thank you, Darren. Well, that was episode 137 of the Dash podcast. If you found this to be informative, please like, share, and subscribe. It's very much appreciated. It's Friday night where I am. I hope wherever you are in the world, you have a Dash-tastic weekend. Stay positive, stay humble, but most importantly, stay dashy.